Welcome, Bitcoiners. Welcome, accountants. Welcome, Bitcoin accountants. This video will be the first in a series that I'm doing on crypto tax law. There have been major changes over the past few years or so dealing with gain and loss reporting, how to organize records, and who can forget a brand spanking new form we'll be getting called the 1099-DA. So if you are a crypto investor or trader who wants to lower a tax bill, a tax advisor who needs the right information, or you suffer from a rare type of hard-to-treat insomnia, this series is for you. I would encourage you to watch the whole series. It's too big a concept to cover in one shot, and I may offer some technical corrections in later videos as I get your feedback. We're going to break this down into 3 parts, which are timestamped in the timeline below. First, I'd like to give an overview of the concept of basis, which is critical to the discussion. For my whip-smart accountants and fellow tax lawyers, this will be basic stuff, but still worth a listen in my opinion, given how it fits into the rest of the discussion. Second, we're going to take a look at the key statutes, regulations, and IRS guidance concerning account-by-account reporting of gain and loss in digital assets. Effective this year, these authorities replace the option to report gain and loss universally across crypto wallets in favor of the account-by-account approach. Third, I'm going to bridge these very technical concepts into what actually happens on the blockchain so that when you put down the books, you'll know what to do. Stick around to the end because there's only a short time left to get this right. So, part 1, basis. Let's revisit the concept of basis. Basis is just a word that means the number we're going to use to track how much tax you may have to pay. The regs start with the default presumption that your basis in Bitcoin or a stock or a house is what you paid for it, or your cost basis. But that's where the simplicity ends. The tax law does all kinds of gymnastics with basis. Basis is movable. You can receive a transfer basis from somebody else. Basis is adjustable. You can move your basis up or down by depreciating a business asset or by paying tax in an exchange. Basis is usable. The new crypto law that we'll get into distinguishes used and unused basis. Think of basis like a yellow sticky note with a number on it that gets pasted to a piece of property. You can move the note around or erase what's on it and write something else. If you have a taxable transaction and it's time to file your taxes, you peel off the sticky note, look at it, and use the number to do the basic math. With that in mind, let's talk about crypto tax reporting prior to 2025. Previously, taxpayers had more flexibility with how they assigned basis to their crypto holdings. Investors could use universal pooling of assets to determine gain and loss. That meant that investors could look at all of their hot and cold wallets, all of their exchange accounts, and pair like cryptocurrencies across these different media to come up with the tax due. The law viewed all crypto assets as if they were held in one huge omnibus account. From this theoretical account, you could select the basis allocation methodology that was most favorable to you. These include the default and very familiar first in, first out, or FIFO methodology, in which the basis of your earliest purchase is assigned to the sale of the like assets sold. But there are others, like LIFO, or last in, first out, which sometimes gave you an advantage if you had more recent, higher cost crypto purchases. You could also use a specific identification method, which permitted assigning the basis of a specific digital asset unit, a particular coin, to the one sold, provided you had sufficient documentation. Naturally, these options gave taxpayers quite a bit of flexibility in sizing up their taxable gains and losses, and was convenient given how different all of the wallets and exchanges could be. Now, during this time, non-crypto covered securities, like common stocks, didn't enjoy the flexibility of the universal pooling approach. Section 1012C of the Internal Revenue Code has required account-by-account calculations for these for some time. As a practical matter, not too many people were concerned about this since traditional finance has long had the infrastructure to make account-by-account calculations fairly easy, such as by allowing clients to leave standing instructions with their brokers to specifically identify lots to be sold and so forth. There are also systems in place to track basis. In other words, clients had an easier time in TradFi creating the records they would need to use the allocation method they wanted. Okay, so stocks and crypto were treated differently, so what? Well, in 2023, the U.S. Treasury published regulations under Section 1012 to include digital assets within the definition of covered securities, which was to become effective on January 1st, 2025. In other words, the government standardized things so that the way you calculate gain or loss, the records you need to keep, and what your allocation options are now the same, that is, account by account. Great. We love simplicity, right? Well, remember the infrastructure we just talked about? It just wasn't there for crypto. Crypto holders still had a mess of hot and cold wallets and exchange accounts all over the place. There was no analogous system for organizing this information in the way the IRS wanted to see it organized. Crypto holders and their accountants were distressed. Not to worry, the government said. We're going to give you a temporary fix through which you can clean up your act and get ready for account-by-account basis allocation. So we enter part 2 of this discussion, Revenue Procedure 2024-28 and beyond. In somewhat plain English, RevProc 2024-28 basically says, okay, we know your basis is all over the place, so what we're going to do is give you a safe harbor to allow you to make reasonable allocations of your unused basis to your present holdings, so long as you can follow certain rules. What rules? There are 5. First, the taxpayer must be holding crypto as of January 1st, 2025, for which there is unused basis lying around to be allocated. In other words, the safe harbor applies to hodlers, those who purchased crypto sometime before 2025 and were still hanging on to at least some of it as of January 1st. If you sold out completely in 24 or are a newbie buyer here in 25, the RevProc doesn't apply to you. Second, you can't be sitting in hot water with the IRS with respect to the unused basis you want to use. Hot water here means a pending audit, appeal, or tax case. Third, you can't mix and match cryptos. You can't, for example, apply your Bitcoin basis to your units of XRP, much as someone might want to do that. Fourth, you must be able to identify and maintain records sufficient to show quite a bit of detail about your unsold crypto. So, for those batches of Ethereum hanging around, you must be able, for each purchase, to show what you paid for each lot and the purchase date. Fifth, your allocation is irrevocable. Once you assign basis to unsold crypto units, you're stuck with it, so do it carefully. There are other requirements, and this summary is no substitute for reading the RevProc in detail, but this is the general idea. All told, RevProc 2024-28 was a gift. It gave you a pretty broad brush, that is, reasonableness, with which to paint the story of your portfolio in a manner best for you. There are 2 flavors of reasonableness: specific unit allocation and global allocation. These are ordering and assignment rules. Let's take an example of the specific unit allocation approach. You hold a total of 200 Bitcoin on 2 separate wallets, 100 Bitcoin on a Ledger wallet, and 100 Bitcoin on a Treasure wallet. You bought the Ledger wallet Bitcoin back in 2015, that makes you a Bitcoin OG, for a very low price, giving you a very low basis. You bought the Treasure Bitcoin in 2024 at a much higher price, giving you a higher basis. Now you want to sell 10% of your holdings, or 20 Bitcoin. Well, if you qualify to use the safe harbor using these rules that I explained before, you can allocate the high basis from the Bitcoin on the newer Treasure wallet to your older Ledger wallet Bitcoin and pay a lot less tax than if you were already stuck with the account-by-account approach. That's pretty handy. What about the global allocation method? Under this method, you adopt a written rule that first orders all the unused basis crypto units by their specific characteristics like the date acquired or their basis. Think of a new deck of cards with each card sitting on top of the next card in the sequence, like ace, deuce, trey, and so forth. Each card represents an amount of basis. When you're ready to sell, you deal the cards out against the crypto units you want to sell in an order that makes the most sense for you tax-wise. Here's the problem with the global allocation method. That door has closed for most taxpayers. It required that you had created your ordering rules prior to January 1st, 2025. Some very talented crypto CPAs I follow sounded the alarm last year for people to do this, but understandably didn't get too far in exactly how, in part because it's pretty difficult to explain and there's not that many of us to explain it. If you had the proper guidance at the time, good for you. But if not, don't worry, there's still some time to shuffle your basis cards under this specific unit approach. That said, don't sell until you figure this out and don't wait. The RevProc gives you until the due date, including extensions, of your 2025 federal income tax return to implement this strategy. I suggest you start now. So, part 3, where do we go from here? Well, as I mentioned, there's still a chance to mix and match your favored basis with the crypto units you want to sell before we're locked into the account-by-account methodology. To relate this back to our Ledger Treasure example, going forward, you could be trapped in the wallet where the Bitcoin is actually sitting. For the new Bitcoin on your Treasure, maybe that's not such a big deal since your basis is high and you recently bought it. But for that vintage BTC on the old Ledger, your OG stack, Well, either hodl on or get your checkbook ready for the tax man. He's going to take a bite. To wrap up, I'd like to zoom out and make two key points. First, if you're not able to apply the safe harbor, the world is not going to stop turning. It's just that you'll be stuck with that cruddy FIFO allocation presumption, and your tax will be simple math, amount realized less adjusted basis, on a wallet by wallet or account by account basis. Second, the safe harbor may not be that big a deal for you if you've always bought, sold, and held using the same brokers and the same wallets, which means you haven't had to pull unused basis from different places. Or if you YOLO'd in to most of your crypto some time ago and your cost basis in those units is more or less the same. If, on the other hand, you've always dollar cost averaged in your buying, or you have crypto widely distributed across multiple exchanges and wallets, we need to chat. Whichever boat you're in, contact me for a consultation as to how to reduce your taxes and organize your crypto affairs going forward. I don't personally prepare tax returns, but I do work closely and cooperatively with my clients' CPAs and some very good, very specialized people in this industry. I can also put you in touch with my team of blockchain archaeologists who can help work out all your basis woes and get these records straight. These people have saved me from the serious shortcomings in the crypto tax software that's out there, most of which is still pretty lousy. Perhaps they can help you too. Also, if you're a tax professional and you heard any errors in anything that I said, please let me know and I'll make technical corrections in a future video. Close enough, maybe good enough in hand grenades and horseshoes, but not in the tax law. I'm Ari Good, blockchain lawyer. Thanks for watching.